G'day listeners and welcome to another episode of the Scouting Australia podcast powered by Australian Property Scout Buyers Agency. I'm your host, Sammy Gordon, and today, guys, we are talking all about land tax. And joining me in the studio is Mr. James Ibrahim.
Oh, wow. Who's he?
Mate, how are you?
Very good, Samuel.
Welcome back to the show.
But this is a very topical topic, Sammy.
Okay.
Yes.
Is it?
Especially land tax. There's a lot of talk about it in the media.
Yes.
There's a lot of misinformation about it potentially.
So, guys, the reason for this podcast in particular was my prior assistant. We'll just say that. My ex-assistant back in the day, she asked me once, well, I bought a deal for her and they were about to buy another deal. And she's like, Sam, I don't want another one in Queensland because I don't want to pay land tax.
Yes.
And I was like, are you kidding me? And she's like, no. I refuse to buy another one in Queensland. I do not want to pay land tax. And I was like, okay, sweet. Maybe you should be head of strategy, head of APS in general. If you're going to give me such forceful, bloody directive around the next deal, I'm going to source you. But no worries, we won't buy in Queensland, even though at the time it was the best place in Australia to invest.
And you love being told what to do.
Oh, the best of
Especially.
times. This lady had been my assistant for over 12 months, right?
Yes.
At the time when she said it to me. It just blew my mind. To be dead honest, nothing against it. It gave me the idea for this episode
100%.
and wanting to do this episode.
Yep.
So all jokes aside, it really struck a chord with me because of someone that was in such close proximity to me as an investor and knowing the way that I invest and do everything and listen to the podcast and everything to do with it. It struck a chord with me of just like, how can this person make a decision based on that just around land tax? And it just made me realize that so many people have this misconception and belief, this misbelief internally around land tax and how important it actually is in terms of investing.
Yeah.
Hence the reason for today's podcast, Jimmy.
Okay. Now I was just going to say, if she's saying that to you, imagine what the average Joe Blow on the streets are thinking. So can you just explain what actually is land tax for people that don't really understand, just to make it super simple to kick it off?
Easy, man. So land tax effectively is it's a state tax, state-based tax, same as stamp duty. And yeah, man. So effectively land tax is the rateable land value of the asset that you own. There's a certain amount of rateable land value.
Okay.
When you tick over a certain amount of rateable land value in a certain state, you will incur land tax.
Got it.
Now, every state is different. Some states don't have it at all. Some states and or territories don't have it at all. And some have quite expensive land tax.
Melbourne.
And so when you need to know, Melbourne's a city, mate. Victoria, yes. State-based tax. State-based tax. All right, okay? Fucking hell, mate. You got me on a tangent. This is supposed to be good, punchy, and professional. This is not what we're being right now. Anyway, state-based tax, relevant to the rateable land value. Now, a lot of people get this mixed up, especially early in the piece. They think land tax is associated with the actual value of the asset. Now, this is incorrect.
Okay.
It is the value of the land component of the property that you own. So for example, Victoria, like we were talking about with Jimmy before, you might own a property that's worth $1 million, but your rateable land value might be, depending on the location, $500,000, $600,000, $800,000, $200,000, whatever it is. So whatever the rateable land value is, so what that block of dirt is worth in that area is what your rateable land value is. Now, what they do, different states will group it. So different states will group every bit of property that you own with you as whether it's in a structure or it's in a company or whether it's in your personal name, whatever it is, they will group it all together and effectively charge you for the entire amount. So there's no way to avoid it. Different states and territories allow you to have segregated between personal as if it's its own entity, so your own personal properties, and then also whatever's in a potential structure may have its own land tax threshold. Now, the point of this podcast isn't to go in depth into each individual state and territory and what you can and can't do and what amounts to what, all the rest of it. You can literally go and find that very easily on any website, on any state-based website. If you just Google what's the land tax thresholds in Victoria or wherever it is, you can find that quite easily. Or if you're in School of Property, I've got a breakdown of this with my personal accountant in the accounting, advanced structure and accounting module in there as well. And we actually go through each of it and how to mitigate and all the rest of the sort of thing within the land tax component, right? Okay. The point of this podcast is to actually discuss, should you be worried about land tax and how much should you actually factor it into the equation? Anyway, so really what we're talking about, and so to break down really what it comes down to is there's just so many different facets as to whether you need to worry about land tax in your state, and how much it does rack up, how to potentially mitigate it and get around it, all sort of thing. That is definitely something to bring into the equation if you're looking to load up big time in a particular state. But that's just how to mitigate it and really run the avoidance, not the avoidance piece, but mitigating it, to the scale point. The other thing to throw into the equation is your primary residence is exempt from land tax in every state in Australia. Every state and territory in Australia, your primary residence is exempt from it. It is only for investment properties. And again, every single state is different based on.
Okay. Is there any other type of properties or land that is exempt from land tax? Like apartments or?
No, different states and territories. Some are completely void of it, and then others have quite exorbitant amounts. What the thing to take into the account is when you own land. So obviously, as I always say, land's an appreciating asset, buildings are buildings appreciating asset, blah blah blah. And so the more rateable land value that you have, or the more land value you have in a certain area, that may be something that appreciates more in value because of its proximity. In reality, everyone loves to talk about this. It's kind of a load of shit. Like if you own something in a certain area, like it all goes up. But so often we see rising tide lifts all boats in an area, right? So it just doesn't matter really in essence around that piece. If a market and a city is going to boom, proximity, land value, it's all relevant to what you undoubtedly pay for an asset in an area. So whether you buy a unit, whether you buy maybe a subdivided block or a townhouse or a house in that area, so often, and yes, different areas will be specific that they may grow differently, but there'll be times where units will actually outperform houses, even though they have a smaller land component. But the thing to weigh into and factor into the equation in this as well, like one other thing that is quite large in terms of a difference is a unit in the same area as a house. So let's say there's a half an acre block with 50 units or whatever, for example. Those 50 units share the rateable land value of that block. So their rateable land value might be $50,000, $100,000, $200,000. Whereas the 500 square meter house next door or on the same road, it might be, let's use that example, whatever. It may be $1 million worth of land value or something like that. Just remember that your land tax will be massively affected by, or your land, you have massive land tax exposure at that level. It's pretty much any state in Australia, you're going to have quite large land tax exposure at that level. Now, the other thing to take into account is most states and territories haven't really adjusted them very much in a long time. If anything, they've adjusted them down and made them more expensive, wherein over the last decade, as we all know, property prices have increased quite substantially. So getting your head fully around this and wrapping your head fully around this, it is very, very important. But because there's so many states, territories, everything to take into account, and so many of them are have been great investment locations over the last 5 to 10 years, it's really important to wrap your head around where is relevant to your specific state. Now, what I would say within that is if anyone wants further detailed information within that, most of our listeners or a lot of our listeners are in School of Property, Advanced Structuring and Accounting module, My Personal Accountant. We run through it in depth, in detail around that and give you this sort of the updated plan in terms of how to best strategize around it from that perspective.
Okay. Just before we get into a lot of the juicy stuff, just some basic questions. How often are they reassessed? So is this an annual thing? Okay.
Annually.
And can you challenge that, Sammy? If there's an unfair valuation, or can you appeal a valuation?
You can. I've almost never seen it approved. This is the thing.
A few times.
Yeah. So I used to back in the day. The crazy thing is like every year they'll bump it up, but they never adjust their rateable land values. They never adjust their land tax thresholds.
Okay, so they keep the thresholds low.
So what a lot of people didn't realize is that in Queensland, when Queensland brought in, they were going to group all properties in Australia and they were going to tax you on everything. What a lot of people didn't realize happened very shortly after that, when they scrapped it in 91 days, no one really checked their rateable land values the next financial year, and they pretty much jacked everywhere. Everywhere went through the roof. So even though they missed the tax grab that they were trying to go for, they would have massively increased their land tax earnings anyway, because they just jacked all the values in that financial year. And so, a lot of my properties, I remember a lot of my properties I had out in Ipswich. And I mean, yeah, we have seen some massive gains, but there was a lot of them that were out there that were sitting in the around 100,000 rateable land value. Then went to like 300,000-400,000. You're literally talking like a matter of years. And yes, they did go through considerable growth, but it was just wild to see how massive that change was from the rateable land value perspective. So every single year they'll reassess. And if anyone who's owned investment properties, you see the rateable land value or the value of general letter that most of them will get every year. That's relating to what your property's been assessed at and undoubtedly increased to. Most council rates also have the rateable land value on them as well. So if you're not sure what they are, almost all council rates have their rateable land value of your asset on the council rates that are sent out.
So I suppose people listening are just getting the question in their head. Okay, Sammy, I get it. Land tax, you can't avoid it in certain states, but should this stop me investing is ultimately because if we can't change land tax,
Yes.
and from the sound of things, from what you're saying before, we can mitigate it in some aspect if we understand a little bit more per state.
Yes.
But overall,
Yeah.
should we just treat it as a cost of doing business, or should we just stop investing in a particular state that has high land tax?
Yeah, man. So for me, in all reality, dude, I don't care about land tax at all. It's a cost of doing business. If there was one state that was the highest in Australia for land tax, but also had the best growth prospects in the country, I'm going to invest there every day of the week. I'll do everything I can to mitigate my exposure to land tax in that market and make sure I'm selecting assets that have got to be honest, actually, I wouldn't even be making sure I was selecting assets that had the lowest exposure to land tax, because as an investor or as an APS investor, and the way that we invest in Scouting Australia podcast listener and investor, you probably are more than likely going to be targeting blue collar style assets. The blue collar style assets obviously have the lowest exposure and risk out there that there is for land tax, because they are the lowest typically dollar value rateable land value per asset, right? So you can stack more of those in the portfolio, have a greater value overall portfolio value, and have a lower rateable land tax exposure. Whereas your blue chip and a higher yield, right? Whereas your blue chip style assets, you might be able to stack $1.5 $2 million worth of blue collar style assets, maybe have $2,500 to $3,000 or $2,000 to $3,000 worth of rental income for that $2 million worth of asset, and maybe only hold $800 to $1 million worth of rateable land value. If you hold a blue chip asset, potentially with not that great a house on it, but really high rateable land value, you're going to have a low yield. So you might spend $1.5 to $2 million. You might rent it for $700 $800 a week, as opposed to $2,000 to $3,000 a week. But your rateable land value will probably be, if it's a $1.5 to $2 million asset, probably somewhere between $1 to $1.5 million for the rateable land value. So you just got this very low yield on it, singular asset, really high land tax exposure. You also can't spread it, so you can spread your risk structure-wise a lot of the time across a lot of states. So a lot of states have, per structure or per entity land tax isolation as well. But the exposure that you will cop from, say, a blue chip style asset combined with a low yield, the people who need to worry about, and the people who do worry about land tax, are those with those blue chip style assets. Because it is something that you can't even really plan around it, because you've got a singular direct asset. So you're going to cop the land tax anyway. There's almost no way to really mitigate it other than, obviously primary residence perspective, which isn't investing.
And also, is it the blue chip holder, they're potentially holding it for the long term, right? So they're going to be holding it for at least 10 or 20 years.
Yeah.
Whereas the strategy that you adopt and APS adopts is these growth properties that we're buying, the blue collar, even though they have land tax, we're not planning to hold them for a long period of time.
Yeah, exactly.
So we're actually mitigating some of that cost anyway, just from selling.
It kind of depends, because the blue chip typically goes hand in hand with the idea and the premise or the strategy of holding for the long term, which to me isn't a strategy. It's just buy and hope. But that a lot of the time goes hand in hand with that strategic piece.
Typically.
But if you were a blue chip investor and you also were an aggressive investor and flipped out of cycles as well, you could potentially still be pulling out sooner. But yeah, a lot of the time that strategy goes alongside it. So it goes along with that
negative gearing
piece. You're losing negative cash flow on it. Your inflation is eating away any profit that you might have had in it if it's sitting stagnant for that period of time. You got your maintenance costs. You got your land tax on top plus everything else. It's just like, it just doesn't make sense, man. But this is where a lot of the time, actually, I'm just going to put a pin in it with this right now. Land tax has nothing to do with an investing strategy, really. Like, it should always be for growth. What is going to give you the biggest and best return, full stop. That's all it comes down to. What is going to give you the biggest and best return in your portfolio? Yes, it needs to be weighed into the equation, but I've never come to a point where land tax has turned me off buying in a state or buying in a city or buying in a specific location because land tax was at play. If anything, in some locations, it's made it make a lot of sense to actually buy in a lot of locations. There's locations we bought in that have had really high yields. We can be very strategic with land tax, minimization, and it was at the bottom point of its cycle. It also made a lot of sense. But then, yeah, man, this is where it really just boils down and comes back to the simple fact of land tax should never affect an investing strategy. And you should always invest where it's going to make the most sense from a dollars and a capital growth perspective. And that's all it comes down to. You don't need to get hung up on this or that or whatever. This obviously previous assistant had bought one investment property and was going to deviate the entire strategy for land tax, which she was nowhere near anyway. It made no sense. And like formulating a strategy or avoiding buying in a location because of land tax, especially when she didn't even understand the premise that she wouldn't even be exposed to it, just makes no sense. And so I just want to reiterate, you want to buy in a location that is going to give you the strongest growth potential and the growth prospects for your portfolio. And land tax is just a side consideration of how you should potentially structure that asset.
Yeah.
That is it.
Perfect. So could people see this as an opportunity, Sammy? So in markets that do have high land tax, if there's a lot of fear for the uneducated person, is there a chance for them to capitalize on that?
Sometimes, man, it kind of depends on the time in the market, right? So like, there were times where, I mean, if we look at last year, Victoria kind of across the board came back about 10 to 20% because they made the land tax changes. A lot of investors exited the market, and whilst a lot of investors decided not to buy in that location for multiple reasons. First one being the market was coming backwards. Yields were terrible. Land tax changes had come into effect, and there were better places to invest and to go and put your money. And so, man, really, when that's the equation, you're getting a lot of people pulling out and no one really buying in there. The market's going to come back, which it did, about 10 to 20%. The perfect time for opportunity was probably late last year, heading into early this year, before the market turned, of that sort of dead spot where the market had come back, but it had bottomed. People who wanted to sell sold, people who had to sell sold, and people who were like sort of on the fence and didn't need to sell held. And then, in that period then, that was when it was kind of at that back end period. But you never know how far a market's going to fall before it's the right time. It was kind of late 24 heading into early 25. That was sort of that balancing out sweet spot where the market did bottom out. And then it started a little bit of a rebound curve at the moment as well. And it looks like it is definitely on the up. So it was really interesting to sort of watch that play out and watch that happen last year. But it's very rare. The other thing everyone has to consider around land tax and like, oh, you don't want to do it. It's like land tax changes so often with government. So, the next government could get in and then change it back again. Or there could be some policy that comes in and gets lodged and goes into government, and it gets changed even with current government in place as well. So with anything to do with taxes, I really don't make investing decisions around it. I'm like, what's going to give me the biggest and best return over the next 2, 3, 5 years? And that's how I want to invest. That's the way that I want to invest and make decisions based on that. Not off how this tax might affect me over the next little bit, because we're talking growth properties and we're not going to hold growth properties for the long term. So you shouldn't allow it to dissuade you from an area. But it could potentially be something that helps push you into an area, into buying something as well.
Mate, I think you've absolutely nailed it. We wanted a fast episode. Have you got anything else you want to mention?
No, man, I think one of the other things to take into account is like so often states that have like very little, and we've found this from actually studying markets and seeing different things as well, and different markets we're going to buy into. A lot of the time, like people get hung up on land tax, but so often states that have quite high land tax can also be part, and this isn't always the case. So Victoria is probably the worst for this. They have pretty rough land tax, rulings, and their stamp duty is not the most, they're not the nicest either, right? So it's pretty
double
much the
whammy.
most expensive. Sorry?
The double whammy.
Yeah, pretty much. It's pretty much the most expensive state from both of those perspectives, right? But then you've got other states that have, no land tax, but their stamp duties might be higher. Then you have others that may have a little bit higher land tax, but their stamp duties might be lower. So a lot of the time it's very relevant from that. And that's why I'm just saying, like, this just needs to be purely treated as a cost of doing business and what is going to give you the most growth. What is going to give you the biggest return from a growth perspective. That is how you make a decision based on a growth asset.
Yeah,
and it's as simple
the fundamentals.
As that.
Fundamentals still apply.
When it comes to cash flow is a different consideration. And when we're talking about cash flow deals, whether it's residential or commercial, however we play the game, however we want to play the game that's fitting for you right now, that's where it needs to come into the equation a little bit from that perspective too. But there's different concessions around, there's different things to take into account. There's different things you want to be all over when it comes to stuff before making any decisions around this.
Okay. In commercial properties, can you pass on the land tax to the tenant?
Depending on what you can negotiate in your lease, for sure. So triple net lease covers that.
And yeah, amazing.
Yeah, of course. And it also depends on, what can be negotiated and what is the norm in that particular market. So if in that particular market, a lot of the leases are gross as opposed to net, then you might get the gross amount and the gross amount, so I've got a couple of these in my portfolio where my gross yield is like 10 or 11%, but they then net out at like 7 to 8%, right? And so, while it's not a genuine triple net lease or a true net lease, while it's not that, we just reverse engineer it to see what that number comes in at. And it's almost the same as resi. If you get a gross rent and then you calculate back your net return off it as well, but it's always significantly higher from resi.
That can change your return quite a lot. So for someone who's just trying to do this on their own, you need to be very acutely aware what the implications of that is.
100%.
Yeah. Yeah.
There's so many
absolutely.
facets to really be all over when it comes to commercial. I know we've got a commercial. We're starting a commercial mini series coming up very soon as well, guys. So get excited about that. But yeah, man, there's so many things to really take into consideration and be all over from that perspective too.
So would you like to change the title? Because I came in here thinking I was going to avoid paying land tax. Is there anything you want to change?
Are you
there?
in School of Property?
Yes.
Just go watch the lesson in there.
Okay.
Go into School of Property, listen to the lesson about land tax,
Yes.
and you'll see how to mitigate it.
Yes. She should listen to that episode. Has she still got access to School of Property?
I don't know, probably not.
Probably not. Okay. Is there anything else you wanted to cover off, Sammy? Because I like the punchy episodes. People want to get the info. They want to get on with their day.
Mate, I think it's quite simple. Don't be worried about it. Look at it as a cost of doing business.
Yeah.
You don't worry about it. You just do your thing. You invest based on what's going to give you the most capital growth.
Yeah.
If we're talking about growth perspective properties, when we're talking about cash flow, yes, you want to be all over it from a cash flow perspective. When it comes to capital growth, factor it in as a cost of doing business. Does that state still make the most sense? Does that location still make the most sense from a capital growth perspective that's going to give you the biggest cost versus return outcome out of everywhere that you can invest? And if the answer is quite simply yes, mad. We know what the cost is going to be.
Yeah.
Keep pushing forward. Keep doing your thing.
Yeah, I love it. I love it.
Beautiful.
Sounds good.
Jimmy, mate, thank you for joining me. Listeners, I hope you took some great value out of today's episode. And until next week, that's another Scouting Australia podcast.